Tom Lee, the managing partner of Fundstrat Global Advisors and a CNBC contributor, is with us today. Hi Tom, nice to see you. Hello Carl, how are you? I'm doing fine. What do we make of the market in light of the jobs number and a VIX, which I know you're watching, but is still close to 20 today? Yes, I think we're in a tricky period, because there are these sort of complications, which is geopolitical risk. We've got the port strike out of the way, and I know October has these season. I think it's very good news to see the stock market react positively to a job report, because it is in fact a good report, showing that the economy is actually not only holding up but the unemployment rate's down. But I agree with you, the VIX is important to tell us how much we could rally. I know our head of technical strategy, Mark Newton, thinks that we're making intraday lows today, and it's setting up for us to make new highs next week. To me that makes sense just because it has been a resilient economy, and then next week we get CPI. But I do think it's hard to say this is a green light into year-end, because as you're pointing out, the VIX is just staying stubbornly high. If it is now looking more like a 25 basis point cut in November instead of 50 basis points, does that impact expectations in the equity market, or is that not really priced in at this time? Tom, we've seen some changes in the swaps market regarding expectations for future rate cuts, at least in terms of magnitude. How does that alter the calculus, if at all, for the equity markets? Fed fund, the bond market is impacted by futures and expectations regarding the size of cuts over the next few meetings, and we're seeing that reaction today. Of course, some people believe that the Fed made a mistake with 50, but for the stock market, I believe that even if yields are rising, there will be periods when the S&P will rise because yields can rise because economic data is better, and we're kind of rising for good reasons on yields, and I think that's support of a stock. Therefore, I'm not too concerned if the odds of a 50 have dropped today due to a strong jobs report, because I don't think it means that FE is abruptly reverting course and going back to being mode on China. Tom, is it good for global growth? But how is it offset, if at all, by any kind of drains to liquidity, or just the rush of hot money to either cover shorts over there or try to play along with us? I think on balance it's very good news that China's BOC and the government have launched a bazooka series of measures, because it has been, on a relative basis of drag, not only on the global economy, but a huge underperformer for the past 10 years. I don't think us investors are selling their equities, or even small cap stocks to buy China. I think it's coming out of all this cash on the sidelines. We know margin debt hasn't moved for 4 months, and it's still way below the 2021 highs of $936 billion, and we know there's $6 trillion cash on the sideline, so I think this is motivating money into action. But at its overall, I think the posy back. I just got back from Asia's second trip. In the last 6 weeks it's more firm. I am actually more incrementally more bullish, because everything we're seeing in terms of chip demand, the use cases that are ultimately driving AI, and the hyperscale to Microsoft, I believe this is actually just the next leg in Microsoft. I think numbers go up much higher for 2025 just given our view, the AI revolution. We're in the early days, and I think it's a risk-on environment for tech going into why is the chip trade been so squirrely. Then I think the concerns about ultimately is demand softening, and that's why we spend so much time in Asia. We think demand's outsham and supply 15 to 1, and it speaks to the bullishness, not just on Godfather of AI Gen's Nvidia, but it just when you look at overall the hyperscalers, it's Microsoft, it's Amazon, it's Google. That's the foundation. That's now what I view is the second, third, fourth to river. That's why names like Pal are front and center in terms of the use case names, where I think many institutions kind of put it by the side. Now it's front and center. And you think there's enough that's not in the stocks, cause a lot of what we're talking about is known, it's expected at this point, and that's why the valuations and the prices have been bid up. In our opinion, I believe streets underestimating numbers across the board, in tech 15 to 20%, when you look out next 2 to 3 years. And that's really our thesis, is that as these use cases build out, you only have 3% enterprise that actually gone down the AI path. You have $1 trillion of AI capex coming, and it's SE. I see it feed on the ground in Asia. And that's why I get the bears come out of hibernation mode and try to scare many. But I think when I look at tech, I believe this is a tech best performer in the market, up 67%. People at the start of this year in January, They said okay, now they're going to rotate away from the AI darlings, we're going to do something else. It's 8 months later. Guess what the number one performing stock of the year is? Nvidia AI is tied with Vista Corp. They're both up 136%. So at a certain point Nvidia can't be up 136% every single year. But this idea that we're all going to be smart enough to know when this is it, this is the top, and it's time to rotate out, it continues to fool people. Nvidia continues to stay bid everybody that you come in contact with. And I mean everybody says to you, oh, you're in the investment business, what do you think about Nvidia? And there are people who have no idea what Nvidia is. I feel like, don't you feel like that's cooled down a little bit? Yes. But that's good, that is healthier for the market. It's GameStop. It's like we should all own GameStop because we heard it from the person cutting our hair. I don't think so. So it's the same dynamic. You have to have something, and the professionals who are buying these stocks, I mean, we know the companies we're buying. It's not just the S&P index that's moving higher, it's other buying in addition to it. I'm not suggesting we're not going to have Nvidia earnings watch parties anymore, because there's still going to be a thing, but it does feel like a little bit of the fervor about that has cooled a bit, which is good. I mean, you make the argument that's good now. You know, outside of the mega caps, you do have the filing of an IPO by a chip maker. It's a Cerebras. Maybe they'll take on Nvidia. The latest funding round value, that company 4 billion backers include Sam Altman code to altimeter benchmark a plant to go public in the NASDAQ. I'm not sure. But according to BofA today, the most owned semis are still relatively underweight. If you want to believe that, Steph, what do you think of that? I know I'm but that's what happened when you're at 8% of the S&P, or 6%, 6.5% with Nvidia. And whatever it is, 2% with Broadcom, that's 10%, and two names close to